Welcome everyone to the Business 101 webinar series from HKA. I'm Nick White. I'm one of the accountants here at Hot Cruising Associates. I'm usually joined with Jordan Coolingle. He's out on a well-deserved vacation this week, so I'll be leading the webinar this time. So today we're going to be talking about reading the financials of your business. So the agenda for today, we're going to talk about some of the standard financials that you should be paying attention to, customizing those financials to meet your needs. And then one of the top topics that we get a lot from our business clients is, should I be on a cash basis or accrual basis? So we'll be touching on that for a little bit. And if you have any questions, feel free to use the chat function in the webinar. We'll make sure to get those answered. So the very first financial statement that you should be paying attention to is the balance sheet. So this is a snapshot in time of your business status. So this consists of assets, liabilities, and equity. Most of our business clients know the difference between assets and liabilities. The equity section is a little bit more cloudy, but assets are the cash, receivables, and equipment items that are working on behalf of your business. And liabilities are what's owed to outside parties. So what your business owes to somebody else, like accounts payables, lenders, credit cards, things like that. And then the equity section, so this can consist of a couple of different things. So first thing that's very common is capital contributed by the owner. So starting off the business, the owner will contribute capital into the business that's going to run through an account of owner contribution. If the company has stock, distributions run through this section. So if there's any profit that's taken out of the company by the owners, it's running through the equity section. And retained earnings, which you'll see on every balance sheet, and that is simply just the profits that are left in the company over time. How to use the balance sheet effectively. So the balance sheet can point to a lot of key indicators of the company's performance. One of the big items is knowing the company's liquidity needs. So is there enough current assets in the business to pay off any current liability? So do I have enough cash to pay my accounts payable off a certain time? Do I have enough cash to get me through the next couple of months without needing to worry about injecting capital, allowing the owners to put money into the business to keep it running? It can tell you if the company's overbalanced by debt. Is there too much debt on the books for the company to sustain itself long term? What I just touched on briefly is the company capitalized enough? Is there enough cash and receivables to keep the company going? A couple of the common errors that we see on the balance sheet are capitalizing small expenses, so items that maybe a couple $100, $500 that don't need to be depreciated. Over time, we'll want to go ahead and get that over to the income statement, so that gets fully deducted and runs against the expense section. And the negative balance sheet items, so these often indicate improper accounting, a mistake was made somewhere. So if you see that on the balance sheet, so if it's a negative liability, something got coded in the wrong place, so you want to go ahead and investigate that and code that to the right spot. Catherine, do we have any questions at the moment before we move on to a balance sheet example?
No questions right now, but if you have any during the course of the webinar, you can send it to me in a chat or use the question and answer function.
Perfect. Okay, so moving on, we have an example of the balance sheet right here. So on the left side, we have all of our assets, and on the right side, we have all of our liabilities and equity. So a balance sheet will always equal assets equals total assets equals total liabilities and equity. If those two do not match up, something's wrong. But most of the accounting packages these days make sure everything's in line. So looking on the left side here, we have our current assets like cash, accounts receivable, and inventory, and these are all items that can quickly be liquidated. Then we have our property and equipment, so land, buildings, any heavy machinery that the business owns, vehicles, everything like that. And I know I just mentioned about negative liabilities and assets. The only time you should really see a negative asset on the balance sheet is with this accumulated depreciation account. And that's just over time, the amount of depreciation that the assets have taken. And we have our other assets, which in this example, intangible assets. So there might be a patent on the books. But as you can see, our total assets equal 472,000. Then looking over at our liabilities section, we have our current liabilities of 30,000. We have notes payable, which in my mind, if it's a notes payable, needs to be down into the long-term liability section because it's most likely something that's being paid off over time. Quick rule for current assets and liabilities, if it can be, or current liabilities, it can be paid off within 1 year. It should be in the current liability section. So total liabilities of $247,000. Then we look at our equity section. So we have our common stock, we have our retained earnings, things like that. So equals 472,000. So it equals, that means our balance sheet's relatively correct as long as we make sure our coding's pretty good. But just looking at some of the metrics that I kind of talked about. So if we're looking at our liquidity needs, we have $100,000 of cash with about 20,000 of AR. So if I take it, that's 120,000. Compare that to our current liabilities, we're about 47,000. So I have enough cash in the business to sustain operations for a continued amount of time. So that's a great indicator. Then rolling through to the next slide, we'll talk about the income.
Sorry, Nick, I actually do have a couple questions if you'd like to take some.
Sure, let's go for it.
Awesome. So first question, should I create a depreciation account for each fixed asset account?
I would not. And the reason why you don't want to make your balance sheet too long, you want it to be that snapshot, something that can tell you a quick story of what's happening. In the accumulated depreciation account itself, if you ever want to go in and look at it and see what's going on, you can, but I would not want to cloud the balance sheet.
Excellent. Second question, can you tell us the importance of the aging reports for receivables and payables?
So you're getting a little ahead of me here. So I'm going to touch on that in a later slide, but yes, that is very key. And we're going to talk about how important the aging is and how that affects cash flow. So we'll get to that in just a minute. Was there any other questions?
Nope, that was it. Thank you.
All right, rolling on to the income statement. So the income statement is what a lot of clients look at and see, am I making money or am I losing money? So this is the performance of the company in a set period. So we're looking at revenue versus expenses, or revenue, cost of goods sold, and expenses. We'll touch upon cost of goods sold in here in just a minute. So, and then kind of expanding on that, positive income does not necessarily mean positive cash. We'll talk about that when we talk about the statement of cash flows. But if you have positive income, you might be spending, there might be too much cash leaving the business on long-term debt, et cetera, to make it seem like the business doesn't have any cash, even though it's making money. And then distributions versus salary. This is a common question with a lot of our business owners, especially with S Corp. So on our last webinar, if you haven't looked at it, go ahead and take a look. But we talked about S Corps. And if your business is an S Corp, the owner is required to take a salary, and that's going to be a W-2 wage. So all salaries, W-2 wages are going to be running as an expense on the income statement. If the owner decides that there's enough profit sitting in the business that they can rightfully take out of the business, that's a distribution, and that's going to be running through the balance sheet in the equity section that we just touched on. And then yoking the strength of cost of goods sold. So this is a great thing to pay attention to as well. So the cost of goods sold is reported separately from the expense section of the income statement. We'll take a look at an example here in just a minute. But the cost of goods sold, think of it this way, is our direct costs to the items that you're selling. So if you're selling cheeseburgers in a cheeseburger stand, your lettuce, your bread, your meat, that's a direct expense, direct cost of goods sold of doing business. So a great way to use this function is to measure your gross profit, to measure yourself with maybe some other companies in your in your industry to make sure your gross profit levels are on par or even better. Do you have any questions before we get to the example?
Not yet.
Cool. All right, so this is the example. Very, very simple. So we have our sales. So this is our total revenue. Then we have our cost of goods sold. So in the cheeseburger example, if I sold 125,000 worth of cheeseburgers, I spent $71,000 of material to make those cheeseburgers. So my gross profit on my sales were at $54,000. So I made $54,000 by directly selling the cheeseburgers. And then our operating expenses, so these are going to be things that will allow my business to operate, to keep the doors open, et cetera. So in this example, we have our wages, we have rent, advertising, and depreciation here. So as you saw in the balance sheet example, we had accumulated depreciation, which tracks the total depreciation that has been taken on those assets over time. When depreciation is expensed, it's just that depreciation piece for that set period. So in this example, it's taking our gross profit of 54,000 minus our total expenses. And so our net operating income is at 46,400. All right. And then moving on to the statement of cash flows. So this is often overlooked, but provides just as much information and key information as the balance sheet and income statement. So an easy way to kind of think of this is it's all the cash that's entering and leaving the company, and it's made up of three sections: operation activities, investing activities, and financing activities. So the operation activities are cash sources that are direct business activity. So when we looked at that income statement, we had salaries, we had advertising, and even revenue. All that's going to be running through the operation. So in the case of that past income statement that we looked at, we would have a positive cash flow of, let's see here, of 46,400, just as an example. And then investing, that's cash sources derived from companies' assets. So in short, if you have any changes in equipment, if you bought equipment, sold equipment, that's going to be running through this section. Financing, that is any cash derived from investors or vendors. So if you receive cash from a loan, if you receive cash from an outside investor contributing capital, it's running through this section. And looking at our example here, so it's just, this is a very simple cash flow statement. So cash flows from operating activities. This is a lot of information running from the income statement. Investing and financing activities, a lot of the cash coming in and out, we would be seeing that from our balance sheet. So we'd have a net increase or decrease, and this would be a great tool to make sure that the business is actually keeping money, growing the cash balance, and then once you see the cash balance grow, you're able to take out the excess profit for distributions or use it to invest in the business and possibly purchasing equipment or hiring more people, etc. Catherine, any questions on cash flows?
We we actually have a question that came up right after cost of goods sold, so
Okay.
I can read it to you if you don't mind going back a minute. So the question was, could you explore a little bit more fully how we should determine what goes into cost of goods sold to maintain comparability with other periods or peers?
Okay. So really try to break it down to what am I buying that directly goes into a product that I'm selling. I think that's the best way to describe that. So say if you're an auto shop and you're providing services to customers bringing their cars in, if you need to buy parts, if you need to buy fuel or whatever is directly impacting what you're selling or providing, it needs to be included in the cost of goods sold. And as far as the comparability, there's a lot of different tools that are out there, and here at Hot Cruiser, we can definitely help you within a study compare what your costs of goods sold are compared to what others in your industry are. So if you have any questions on that, we would be glad to help you within that study. And if you find yourself lagging behind a little bit, we can help you come up with a plan to make your financial statements look more attractive, and a plan to get you to the point where you want to be. I hope that answered the question.
That was great. Thank you.
All right, so skipping ahead here. Oop. Here we go. Age payables and receivables. So this is the part that one of the questions jumped a little ahead on. So age receivables illustrates what your customers owe you and whether balances are past due. So one of the things that I like to look at when looking at financial statements when running through the balance sheet is once you get to the receivables section, go ahead and flip over to the age receivables report so you can see the breakdown of who owes you and how long has it been out there. So a lot of the age receivables reports in the accounting packages break it down between 30 days or less, age 30 to 60 days, 60 to 90 days, or even older than that. So the longer that those balances kind of creep past 30 days, 60 days, and 90 days, it's relatively known that you're unlikely to collect it. So if something's way past 90 days, there's a good chance that you won't collect it, which will be a huge burden on your cash flow, because your cash flow from operating activities when considering the receivables will be negative because your receivables have grown so much you're not collecting any of it. And then same thing on the age payables. So that illustrates what you owe to outside parties. And the age receivables report has a direct impact on your age receivable or payables, because if you're not collecting on any of your receivables, then you can't pay your outside vendors for the things that you're purchasing, which would also be a huge impact on your cash flow as well. Some common errors, like I mentioned, letting things age too long. That's a big one. So you want to be contacting your customers to get things collected. If you see a trend of receivables aging too long, there's a cluster of customers or clients that are going out there, come up with a plan quick to get those things in the door so you can use that cash. Another common error that we tend to see as well, it's relatively minor, but applying payments to a vendor bill to the wrong bill. So that might skew your age payables report. You meant to pay something, but you paid something else. So then you have one of the bills kind of showing that it's over 30 days aged. So you want to go ahead and take a look into that, making sure you're paying the right bills. And same thing on the flip side on the receivables. When you receive a payment from a customer, make sure that you're paying it to the correct, or you're applying the payment to the correct invoice, just so you don't cloud your age receivables, because no one likes going to a customer and saying, hey, you owe me this amount, when the customer says, oh, I paid it, here's proof. You definitely want to avoid that. Any questions, Catherine?
I would like to emphasize that it is no fun to ask a client for an invoice that they've already paid, speaking from personal experience. But also, no questions at this time.
Awesome. Okay. Then touching on customization. So I encourage everyone, every business client, anyone that's touching the financials to customize it as much as possible to be bespoke to your business, because I'm very visual, so I like to make things look the way I want to see them so I can quickly make decisions and analysis. And one of the very first things I like to do is recommend is go ahead and enter in the budget into your income statement. So if you have a budget, if you don't get one set, we can definitely help you with that. But go ahead and import that into the accounting software. So when you're looking at the income statement, you have a direct comparison on where you thought you were at that point in time. And then setting up classes and categories. So this really applies if you have multiple locations or multiple facets in the business where you want to track the balance sheet for that location or that specific part of the business. More importantly, tracking the income statement for that location or section of the business. Setting up classes are very easy, and most accounting packages can do this for you. It requires a little bit of work as far as coding the transactions during the month, because you want to make sure you apply everything to the right bucket. but as long as if you get that done, it's well worth the time getting this set up. And then expanding the financials to specific metrics. So in a lot of accounting packages, you can pre-code it to get your current ratios, quick ratios, and that's just really making sure, giving you a percentage rate of where your liquidity needs are, things like that. And then there's a lot of really great outside tools that you can bolt onto your accounting package. We use a lot here at Hot Cruisy. So if you have any questions, if you want graphs, charts, like me, I'm very visual, like I mentioned. So I like seeing the trend lines and seeing some of the projected numbers. We have a lot of tools that can integrate directly into the accounting package to get you what you need. Any questions on this slide before we move to the last one?
Yes, we have a lot of questions for this one. So one question was, what's the biggest mistake that people make when they're setting up their budgets?
I would say being probably a little bit too optimistic, or yeah. So you want to be realistic. Try to be as realistic as possible. Make sure that you pay close attention to your chart of accounts and that you're applying the number for in the budget to a specific chart of account. You don't want to have 6 different kinds of office expense accounts for whatever reason, and then once it's time to compare, your income statement's really long, your budgeted numbers are skewed, you don't really know what went into what bucket.
Awesome. Here's another one. Could you explain classes? So what is the class system and how would people use them for their businesses?
Yeah, so I would kind of go back to our location. So say I'm a retail store and I have 3 different locations, right? So I would set up a class or category. So classes and categories are the same thing. I should have mentioned that. So QuickBooks and Xero, some of the 2 most popular accounting packages. Xero language is classes, QuickBooks is category. So say I would want to track the statement of cash flows and income statement for each location. I would go into my settings in my accounting package and set up location 1, 2, or 3. And so then I can track all of the expenditures and revenue to the specific location. So I can compare, which location is performing the others, and that can tell you maybe why. Can give you some indications on helping specific locations improve a bit.
Excellent. Another question. When you had mentioned kind of at the beginning of the slide that you are a visual person, so you like to be able to arrange things in a way that allows you to see them better. So you use the budget as one example. Like, are there other ways that people can customize their accounting softwares to be able to more quickly see what they're looking for?
Yeah, and that's where I would say to explore some of those outside programs like Fathom and Reach reporting. So Fathom and Reach will allow you to set up trend lines and projections where you can have your bar graphs, you can have pie charts if you want to go too crazy. Things like that would be a great tool to implement.
Awesome, thank you.
Mhm.
I think
All
that's
right.
all we had for.
All right, then going on to our last slide is accrual versus cash. So this is a big question that we get a lot from, or we get often a lot from our business clients, and which one's right for you. So accrual, the best way to explain it, I think, is when something is incurred. So if a vendor gives you a bill and you haven't paid it yet, that's when you're going to recognize that expense, and that's going to go onto your balance sheet in the accounts payable section. On the flip side of things, if you provide an invoice or you provide a service, say you're building decks, you provide the invoice to your client after you've built the deck. They haven't paid you yet, but I'm going to go ahead and recognize the revenue because I've issued the invoice, so I'm recognizing the revenue. The benefits of the accrual system are it provides more accuracy on the financial state of the business. So when looking at the balance sheet, if you're running a true accrual basis, you're looking at cash, your accounts receivables. So if you're running cash basis, that accounts receivables isn't going to impact the balance sheet when thinking and planning on accrual basis. And then you can project future cash flows. So running the statement of cash flows on an accrual basis is very key. And then cash basis on the flip side of accrual, that is when you receive cash or you pay, you provide a vendor with cash for something that they provided you. So with cash, so say if I provide a service, they pay me on the spot, that's when I recognize the revenue. If I provide an invoice just so the client or your customer knows that they owe you, say, $1,000 on your accounting package, you're not actually recognizing that revenue until your customer pays you that $1,000. So that $1,000 won't hit that income statement until you actually receive the money. The benefits of cash: it's easier to track your cash balances and what's running through the bank. It's very simple. It's an easy way to quickly know the immediate cash balance, but yet again, it won't give you the full true picture of the accrual system with what you have coming through receivables or what you owe with payables.
If you keep your, so here's another question. If I keep my books on an accrual basis, does that impact my taxes?
So that's a yes and no question. So you can run your books on an accrual basis and still be a cash basis taxpayer. We have a lot of clients like that. But if you are an accrual basis cash payer, then yes, it will. So you're going to be paying taxes on what's been accrued, not necessarily what's been received or paid.
Awesome, thank you.
Yeah, and that wraps up today's webinar. So again, there's a lot of good stuff. If you have any questions, feel free to reach out to me. My email is nickw@hkaglobal.com, or give us a call at 314-993-4285. Jordan, again, was on a well-deserved vacation. So if you have any questions for him, feel free to email him at jordank@hkaglobal.com. Catherine, any last minute questions before we sign off?
I don't see anything, but yeah, if you have any questions, you can always give us a call.
Awesome. Well, thanks again for joining us. We really appreciate it and hope to talk to you soon.
All right.